Hello, this is Abhinav Gulechha and I welcome you. In this video, I am sharing some information on the IRS PFIC rules. PFIC stands for Passive Foreign Investment Corporation. These rules are applicable on certain non-US investments. So if you are a US resident and you have certain investments in these corporations, in passive corporations, then you need to comply with the rules. So this is an overview of the rules that in this video I'm sharing, right? Okay, so first a disclaimer that this IRS PFIC rules is a very complicated subject. Even as per the IRS standards, the IRS rules itself are not very easy to comprehend. But even within that, PFIC rules are very even more complex. Please take proper tax advice before taking a decision on your investments and about reporting and taxation aspects. Now, what is PFIC? PFIC, as I explained, stands for Passive Foreign Investment Corporation. IRS has made special rules for taxation and reporting of investments by US residents in such corporations, right? So there are two things. One is the taxation of those investments, non-US investments, and a lot of people are not even aware of that there are such rules, right? But as they say, the general principle of law is that ignorance of law is no excuse, right? So there are two things. One is the taxation, that a separate taxation rule applies, which is not the normal tax rules as per the internal revenue code, and separate reporting requirements also apply for such corporate investments in such corporations. So, if you are a US person, right, this requirement does not apply to non resident aliens, right? So, if you're a US, either a US citizen or you are a US resident, right? US resident means either you pass the green card test or you pass the substantial presence test, right? So, you are a US citizen, US a green card holder, or you are living in US for a substantial period of time, then only this rules apply to you, right? If you're not living in the US now and you don't have a USC or a green card, then it is not applicable to you. So if you're a US person and you are a direct or indirect shareholder or have any interest in these corporations, then there is a reporting requirement and the special rules will apply. Now, I'll come to what are the investments. So basically, the reporting that has to be done is to be done in Form 8621. You can search this on Google. You can just put Form 8621 IRS and you can get the form. Now, this reporting has to be done per corporation per year. Now, the maximum cases where you'll find such passive investments are like mutual funds, right? For example, you are a US resident and you hold Indian mutual funds, right? Or Indian ETFs or Indian ULIP policies. Now, all these cases, they will qualify as a passive foreign investment corporation. See, there is a criteria that is given that there is above a certain percentage, more than 75%, the income or the assets are passive investments, are passive assets, right? So if the corporation is holding such assets or getting such income, it qualifies as a PFIC, right? And if you hold investments or hold any interest or are a shareholder in those corporations, every year you need to do a reporting in Form 8621. Now suppose you have five mutual funds, right? Five Indian mutual funds as a US resident. You need to do separate 8621 reporting for each mutual fund every year along with your tax return. Now, by the timeline is you have to file it with the tax return. If you have taken an extension on your tax return, it is either by the due date of the return, which is like April 15th every year, or by the extension, whatever time that you have taken the extension, generally 6 months. So, this report has to be filed along with the tax return per corporation per year. That means if there are five mutual funds, then five reports along with your tax return. Now, very important thing to understand is that most of the standard tax filing software, I can say about TurboTax, um, and to whatever I know, limited in a way, is that most of the standard tax filing softwares that you see do not allow for filing of this form, right? So if you then have to do it, then you have to get it done through one of the more complex and more sophisticated softwares. But the normal kind of softwares that are prevalent in the market, they might not be doing it. So if you are a US resident and you want to file your tax returns and you generally use these softwares to file your tax returns, then you may check in advance whether they allow for filing of this form or not, right? Okay, now let's come to the Indian investments. For example, you are an Indian citizen and you are living in US. You qualify as a US resident, so you need to do this reporting if you hold Indian assets. Now, what are the Indian investments? So, mutual funds, yes, any form of mutual funds that you have, any ETFs that you have, exchange traded funds in India, REITs, real estate investment trusts. See, because what they are doing is that they all have certain, either stocks, or they have, real estate investments, and it's like a pooled investments, right? So they earn passive income from those investments. They themselves, these institutions, do not, earn any income. They earn passive income. That means whatever that particular stock earns, that is distributed to you, so they may qualify as a PFIC. Now, if you have direct investments in like stocks or real estate or fixed deposits in India, like for example, NRE fixed deposits, that all won't qualify, right? ULIP still may qualify. Whether traditional insurance policies, whether they qualify, disputable. Yes, no. It's this is a highly interpretative subject of tax law. In my view, ULIPs definitely does qualify. Traditional, it's still a yes or no. NPS, I think there is no, because there is some um, uh, exemption that is given to foreign pension plans, right? So you can check on that, right? NPS again may not classify. Okay. Now, what basically happens if there is like a if the investment qualifies as a PFIC? Now, the default tax rate on the investment uh, of the PFIC is, so there is a C in the US tax law. There is a separate taxation of capital gains and dividends, and there's a separate structure that is there. But if it is income from the PFIC, then it is taxable on the maximum marginal rate on any excess distribution that you have got, right? Again, there is a definition for excess distribution, which is one more than 125% of the last three distributions. So that's like a complex thing. But any excess distributions will be taxed at maximum marginal rate of 37%, right? Now, any capital gains from the mutual fund, for example, the mutual fund was of 100 and it has been sold at 150, right? Any excess distribution, any capital gain will be treated as an excess distribution. So that 50, the amount of capital gain, will be taxed at 37% tax rate. So this is a big drawback of holding PFIC type investments while being a US resident. So apart from the very punitive tax treatment, there is also this reporting that needs to be done. This is not a kind of easy reporting. This reporting requires some effort, and this is like per mutual fund or per ETF you need to do this reporting, so it's complex. So then there is this possibility of opting for an election, so you can elect as a qualified electing fund or a mark to market fund. And if you do that, then there is a possibility that the normal tax rates on those investments may apply. One more thing is that if you pay the maximum marginal tax rate on 37%, can you claim a FTC, foreign tax rate, in India? No, you cannot claim. Because if you are a non resident as per the US, as per the Indian tax law, you don't need to declare or pay tax on the income in India, right? So you pay tax on the income in US, and at the same time, you don't pay tax in India, right? Even if you are paying the tax in US, there is no possibility that you can get the credit of that income kind of in India, right? So that possibility is not possible, right? Okay. Now, possible exemption. Now, please check with a tax consultant on this particular thing. There is a possible exemption. Again, if you see the uh, provisions of the instructions on Form 8621, it specifically excludes aggregate. If you have an aggregate investment of 25,000 for a single or 50,000 for a married filing jointly, the aggregate investment in all the PFIC investments for that particular year is 25,000, 50,000. That's the like a kind of threshold. Below this, if it is there, second condition is you have received no distributions from these investments. Third is no gains that are recognized during the year. So you have not taken any distribution. That means the fund has not kind of given any dividend, right? It has not distributed any dividend to you. Maybe you have put your subscribe to the mutual fund scheme under a growth plan, and you don't receive a dividend from that scheme, you have not sold that particular scheme, you have just kept it like that. You don't recognize any gain or loss, right? In If you satisfy all these three cases, then maybe you get exemption from this reporting. Now again, the law is bit, the way it is drafted in instructions to form 8621, if you see, is that it says that section 1291 fund, you don't need to fill part 1, part A, right? The impression is definitely that you don't need to fill this report, because part A is where you give the details of the investment, right? So this is my view, that if you fulfill all these three conditions, then you may not have to file this report, and you may be, not taxed at the maximum marginal rate, right? But please check with your tax consultant on this. Important thing, one more thing, is that this requirement is separate from the FBAR or Form 8938 requirement, right? That is independent, right? So you can check out my separate videos on FBAR and Form 8938. Those requirements, reporting requirements, are independent from Form 8621 requirements. So even if you don't file this report, you might have to disclose those investments in Form 8938, right? Okay. Some suggestions for Indian residents who are planning to become US residents. I have made a separate video on planning to move to US. Check on these points, which is basically a video on pre-immigration planning for becoming US residents. So if you are an Indian resident, you are planning to move to US, and you have Indian passive PFIC type investments like mutual fund, ETF, etc. See, the safest option here is that you liquidate. See, please understand one thing is that US doesn't like US residents having investments out of India, out of US, right? Basically, this regulations come somewhere in 1970s, 80s, where there's a lot of things where people were trying to, um, kind of put their assets offshore, and try to evade tax, because it becomes difficult for the US tax authorities to kind of tax those incomes. So they made these kind of punitive regulations, right? But the issue is that people who are having genuine investments, who are immigrants in US, they are also stuck because of these kind of very very punitive regulations and reporting requirements. So the safest option is that if you have any prefix type of investments in India, mutual funds and all, liquidate all of them before becoming a US resident. Yes, you can check if there are tax implications in India on those investments, liquidating those investments, right? So this is the safest option. Get done with those investments. If you want to invest in India, I want to invest only in India, then you can invest in direct stocks, right? Direct stocks investments or fixed deposits, they do not qualify as a PFIC investment. Otherwise, what you can do is that you can just take that money in your account, repatriate the amount to the US. You might need to fill the Form 15 CA and get a CA certificate in Form 15 CV, right, before repatriation. So you can repatriate the amounts to US, to your US account. You can repatriate up to 1 million. So if you become a non-resident, you can repatriate up to 1 million USD per financial year. And then when you get the money in your US bank account, from there you can invest in US mutual fund or ETFs for the duration of your stay in US. Now, even in US, like, you can split your investments between the US market and the India market. So one is you can take some investment in an S&P 500 index in US. Then you can also take a kind of exposure in a feeder fund, which is basically an India feeder fund, like a Franklin or something. Basically what it does is that you have your investments are, you also get exposure to US markets, and while living in US you get exposure to the Indian markets as well through the feeder fund. And since, because you have invested in a feeder fund which is a US investment, you that doesn't qualify for the PFIC reporting, right? So that is how you can structure your investments. Now, for someone, second option is that if you want to continue with your India investments for whatever reason, you want to continue with your investment, you don't want to liquidate, then what you can do is that you can try to ensure that the aggregate value of those investments is below 25K or 50K kind of threshold. That kind of you can try. Right now, basically, uh, there is no possibility to kind of gift the Indian mutual funds or ETFs, because gift is not allowed. Mutual funds cannot be transferred or gifted, right? So maybe whatever you can do is that at least 25K to 50K you can keep, and above that you can liquidate. Also keep in mind that if the plan is a kind of a dividend plan or a dividend reinvestment plan, you can convert it to a growth option. Because if it's a dividend plan and you receive dividends, then again it will get stuck in the net of pfix, right? So convert it into the growth option before leaving us, before leave us. And during the us stay, do not touch those investments, do not kind of sell those investments. Just let them remain as they are. Even if they are performing not very well, you have to just let them be, because if you sell them, then you recognize gains, and then the pfic regulations get attractive. So that risk is there, right? That you have to just keep those funds like that for the entire duration of your us residency, right? According to me, the first option is better, because then you have that flexibility. You can invest in us wherever you want. If the fund is not performing well, you can move to a different fund. Okay, now if once you return back to India, this requirement will not apply. So if you, when you return back, you become a non-resident alien as per the US tax law, then you don't need to comply with the PFIC requirements from that year. And also, I have made a video on planning to move to US. I will put a link here on this particular thing. So yes, so this is the my post, my video on PFIC rules for Indian investments. I hope it was useful, and do share your thoughts and queries in the comment section. I would definitely be happy to respond. Thank you so much for watching this video. Thank you. Bye.